Well, we've been keeping tabs on stocks this morning as we're seeing the major averages open up positive. Big week ahead for earnings. Can this week's earnings reports spark a broader market rally? To discuss, let's bring in Kate El-Hillo, who is the Russell Investments President and Chief Investment Officer, here in studio with us. Thanks so much for taking the time.
Absolutely. Great to be here.
So let's dive in. I mean, when we think about the early innings of this earnings season thus far, what are we anticipating for the broader theme to be and how markets may react as well?
Yeah, well, I think the hope and what people are looking for is to see if we get this broadening out beyond the big tech, where the 30% kind of earnings, that comes down, that's okay. But whether it's from some of the CPI news last week or and some of the riskier, higher indebted companies end up coming out a little bit better, like small cap companies, for example, or certainly start to look at the consumers as we go into earnings season. Like, is there there's more discipline probably in the consumer spending. You're starting to see a little bit more weakness, but they're healthy still. What's that going to mean for the consumer sectors, and what are we going to get from a forward guidance perspective? But we think that there's going to be a bit of a broadening out that comes through, and we're excited for the season to start.
Is that broadening out going to exclude some of those consumer names because of that pressure, or not yet?
We don't think yet. We think the consumer is still strong. I think it's looking for those forward signals and positioning for the second half of the year.
Mm-hmm. And on that, I know you have some great points in your note about consumer delinquency rates, things like that, just the struggle of that lower income consumer.
Yeah.
When does that become an issue?
Yeah, and I think that's the balance. You've got like the wealth effect helping kind of the mid to upper income. You also have the the lagged effects of the tightening, because mortgage rates for most homeowners are still quite low, and so we don't think that the spending is going to tail off that much. But you do have that lower income cohort that is struggling, and how much does that kind of flow through to the economy? We still think there's some more time before it creates a bigger issue from an earnings perspective.
Yeah, low income cohort struggling right now, higher income right now, not buying Burberry as we were just talking about a moment ago here. I mean, as we think about what the potential growth rate for companies and earnings specifically could be for the quarter, I was taking a look at some of the FactSet data. If 9.3% is the actual growth rate for the quarter, it's going to mark the highest year-over-year earnings growth rate reported by the index since Q1 of 2022. Yeah. What do we need to see and hear from businesses in order for that to come to fruition?
Yeah, well, you're right. So that's on the higher end too of our expectation, kind of at 9%. And you've come out of a period where you're out of an earnings, let's just call it recession, for the non-tech companies. It just happened last quarter. Mm-hmm. So what do we need to hear is that you're still having the discipline around cost, and you're not seeing inflation's coming down, so you get the benefit there, but that the consumer is not seeing any type of tail off. So you are getting kind of that top line growth that you need to see. But if you add on to that Fed cuts that are more, let's say, convincingly being priced in for September, that's going to be better again for some of the smaller cap companies or companies that just haven't participated in the rally. And so we think that will start to come through as we go through earnings.
How confident are you about September for the first cut?
Yeah, we already were in line with a September cut. And so last week, when we've had that 4 months now of just like CPI coming in down after the first quarter kind of challenges. And so we think September is likely, and then quarterly shifts from there.
I want to get your take on the election before we let you go. Not the election specifically, but just, has there been any change in how you're thinking about positioning as it relates to November?
Yeah, well, I'd say the shock and historical event over the weekend, the markets are starting to react to that. We saw it happen after the first debate a bit, and I think this is getting a bit of a preview into what a Trump effect might be if we start to go down that road. I think it's still 4 months to the election, though, and so it's a little bit early to start to make a call. But it's good to see kind of how the market's going to think through the taxes, the tariffs, and some of the implications of a Trump White House, and then potentially even going further down into the Senate and the House. So positioning right now for us isn't changing, but it's helping us give an idea what the playbook would be as we start to get more certainty coming into the election.
What is that playbook, quickly?
Yeah, so it's steepening of the yield curve, right? And so you might still get the inflation coming down where you have the front end coming down, but concerns over inflation, stoking, taxes, tariffs, could create an opportunity there in terms of positioning. And then small cap, REITs, financials, certainly energy. Companies. If you start to get to a point where regulation's a bit lower, you also have just a shift in terms of some of the policy. There's some sectors that have been pretty unloved that should benefit.
All right, Kate El-Hillo, who is the Russell Investments President and Chief Investment Officer. Great to see you, Kate.
Great. Thanks so much.